Hello and welcome to my August portfolio update for my Rubymza portfolio on eToro. Before we kick off, just a quick disclaimer, nothing in this video is intended as financial advice. It's for educational purposes and informational purposes only. So with that out of the way, let's get going. Hi, I am Dr. Heloise Greeff. I am the person behind the Rubymza portfolio, and this is the update for August 2025. I'm one of eToro's most copied popular investors, and I've been managing this portfolio since 2016. Just a quick agenda for today. We will begin with introducing myself if you haven't met me before. I'll talk about my investment style or investment thesis. We've also delved a bit into why people copy me on eToro, so hopefully that'll be quite interesting and give you some insight, maybe even give you some ideas of how this could fit into your investment portfolio. I'll also review the portfolio performance, the current investments, and then also do a market review and market outlook for the rest of this year. So, as I said, I'm Dr. Heloise Greeff. I'm originally from South Africa. I've been based in the UK for more than a decade now. I came to Oxford to do my master's and MBA. Worked for a startup in Kenya and returned to Oxford to do my PhD, specifically in machine learning, where I hold a number of patents and publications. And I continue to live because I love this city. And I joined eToro in 2016 as part of my own journey for financial freedom. And I have been a popular investor since 2017, and I became a full-time PI in 2022. So I now dedicate most of my time to not only managing the portfolio, but also the communication and the education around the portfolio. As I said, I've been working in AI for more than a decade now. I spent a lot of time in Kenya, where I co-founded the Oxford Smart Hand Pump that we patented back in 2014, so more than 10 years now. I then spent time on using AI and remote patient detection for ICUs in Vietnam. And naturally progressed to the stock market over the years. For a long time, did it in parallel. Thought if I could predict patients or mechanical machines becoming unwell, I could do the same thing with the stock market. And that's when I started using AI as part of my investment strategy on eToro back in 2016 when I first started learning. And I've now been on eToro for nearly a decade. I've enjoyed working with them as a partner. I've traveled around the world to not only, speak at conferences, including the Abu Dhabi Finance Week in December last year, but also to present with eToro, to meet a lot of their clients, some of my fellow investors and copiers. And it's just been an incredible journey. So let's get to the key part, my investment strategy. I call it the basics and me. What does that mean? The first layer of my investment strategy is firstly to focus on long-term compounded growth. That means any gains in the portfolio are always reinvested, and with eToro's copy trading ability, it allows you to mirror that without you having to do anything. So as I said, I've been on eToro for nearly 10 years now, and my aim with managing the portfolio is that long-term focus, and I encourage copiers to consider the same when they start copying me. I do really diligent risk management. The aim of my portfolio is to reduce volatility, so I aim to keep a low beta. I'm currently around 0.7, 0.8%, 0.8. And so that means that I'm aimed to give you really good returns without the crazy volatility that you would get if you're just directly invested into the market. And I meet a lot of long-time copiers who say that that is one of the key reasons they continue to copy me, because I give that returns at a much lower volatility. And that's simply how I want to invest in this portfolio, how I am managing my own money. As a popular investor, I have skin in the game too. And then I use fundamentals, so strong fundamentals. And with the current volatility, you have to keep your finger on the pulse with the current economic environment, and that's exactly what I do as part of what I call the basics in my portfolio. Then I add the layer of me. So as I said, I first developed bespoke machine learning algorithms back in 2016. They keep evolving, they keep being fine-tuned. I keep adjusting them as the markets adjust, as I grow as an investor, and they really give us that really strong return. I then leverage, modern technology, eToro being one of those fantastic tools that lets me invest in a transparent and responsible way, where all of my investments, current and historic, are public. They're for you to view. The copy trading functionality allows you to mirror my actively managed fund without any additional fee to the copiers. And I leverage the, low or zero commissions on eToro to build a portfolio for myself and for my copiers to give those gains over the long term. And then I look at mega trends. That long-term focus allows me to look at disruptive trends that really give us that final edge in this portfolio. So why do people actually copy me? I currently have over 6,000 people who are copying me for more than 3 years, many of them, many coming up to 4, 5 years now. So they've been with me for a long, long time. And we had a deep delve into seeing, why do people love this portfolio so much? There are sort of 3 main groups, and it was fascinating to see that people from all risk appetites come to this portfolio. The low risk group really love the safety and the steady pace of growth that you can get in this portfolio, and their typical exposure is almost 100% copy of just this portfolio. The mid-risk group love the balance between risk and reward, and we typically see them being exposed 20 to 60% of their eToro portfolio, along with some other PIs, maybe some other stocks that they have in their portfolios. And then finally, and maybe quite surprisingly, is the high-risk group, who love volatility but really want to get that capital preservation aspect from this portfolio. And they often have a lot of crypto in their portfolio, and they combine exposure to my portfolio between 10 and 30, but I've seen some up to 50%, which really gives them that good, long-term safety, capital preservation, while they still hunt for their greater returns in crypto, perhaps. So yeah, this portfolio is really that sweet spot that meets a lot of different needs. It wasn't intended to be like that when I built it, but I really built it for myself as a portfolio where I can invest most of my investments and sleep peacefully along with everything else that goes on in my portfolio. And I suppose there's just many people out there who are seeking the same kind of portfolio in their investment portfolio. So let's look at the performance. As I said, I really aim for low volatility. So giving you that balanced growth with strong risk management. I keep inching that portfolio volatility down. The last time I reviewed the portfolio, we were at 3.9%. I have just kept pushing that down to 2.7%, but not at the risk of any losses of returns. The year-to-date return on 5th of August, when I put this together, was 25.1%. And the portfolio continues to deliver predominantly consistent risk-adjusted returns over the last nearly 10 years now. If we look at the year-to-date change compared to other indices, the S&P is currently at about 8% for this year. We are here, the Rubymza portfolio is at 25%. Europe, the stock 600 has done also around 8%. And the Hang Seng is really the one that is sort of driving the closest this year. But to put it into bigger perspective, the Chinese market really bombed out in 2023, 2024, when Hong Kong really looked cheap. And so we've seen that big mainland flows, the changes in AI and policy to drive that returns into this year predominantly. So overall, really strong performance from the portfolio this year compared to other markets. So what does the portfolio look like inside? I have what I call sort of 5 main themes, and it's a barbell which has that strong AI cloud leaders on the one side, which I balance with financials and more recently defense and industrials. And that has been in great part the strong performance that we have seen in 2025. So about a third of exposure to AI and cloud leaders, that's giving us that strong thematic drive as we see AI driving a growth across different sectors. We have digital infrastructure exposure, so that's sort of the nuts and bolts behind that AI growth. And then not being overexposed, making sure that we have quality financials, so the big banks, both in the US and Europe as well. And then a strong sort of thematic which we've introduced this year has been the defense and industrials, and that has really paid off. And we'll talk a bit more about that when I look at the thematic growth in the market this year. So overall, that's the portfolio distribution at the moment, and it's been paying off big in 2025. So the market review for the first half of this year, it feels like it's been multiple years compounded into one without a doubt. I mean, we had the Trump inauguration in the beginning of the year. We had the Trump tariffs really hitting the markets hard going into March, April. Coming out of that strong was the US-China truce on tariffs. And that nail-biting moments of the strikes in Iran where, media was not letting us sleep, talking about potential World War III. And all throughout this, we have seen world stocks continuing to climb higher into record highs. And a part of our strong performance this year has been that conviction in the stock market, in its rebound, and making sure that we take strong returns from that recovery that has happened since April, and that we have seen in the portfolio in a great way. The first half of this year has really seen a record activity in debt listing, across particularly the European markets. We've seen more than 7,400 new bonds being listed, which raised over 2.1 trillion in capital. And the strong performance really reflects the high issuance volumes by a broad and diverse base of issuers, which has come from financial institutions, corporates, sovereigns, and supranationals. And for Europe, this has really meant that we've seen that really, really strong performance in the European market going into the first half of this year. And that strong drivers in Europe has been underpinned by sort of three main key drivers. I'd say the favorable interest rate, those successive interest rate cuts by the European Central Bank have significantly lowered the cost of capital, which has encouraged issuers to come to market to secure funding on improved terms. And that's been a really strong driver. That ongoing refinancing needs means that issuers across different sectors have returned to markets as we, had those nail-biting moments for the upcoming maturities. They've come onto the market, they've locked in lower borrowing costs, and they've really optimized their capital structure, which has placed them so well for broader execution, visibility, and a responsiveness to meet that evolving issuer needs. So overall has left Europe in a really strong position, and our portfolio has taken advantage of that. Where we used to be predominantly exposed to the US market, we now sit at about 65% US exposure and 25 to 28% European exposure. So that strong shift to Europe has given us a strong return. Having said that, and despite having the US as one of the worst performing developed markets for the first half of this year, that is mainly because we still see those lingering concerns that the world's strongest economy might be heading for a slowdown. But that strong rebound that we have seen post, the tariff slumps in April, really those US markets continuing to go to all-time highs, particularly in the US compared to other markets, highlights the incredible resilience of investor sentiment, especially in the face of geopolitical headwinds, inflationary concerns, and that ever-evolving government policy. And if we look at the broader macroeconomic and regulatory environment, that continues to evolve rapidly. It means that central banks, governments, and corporations alike have to keep adjusting accordingly to ensure that they remain adaptable. And they have done that. They have shown that going into the first half of this year. If we then take a bit of a zoom in and we look at the thematic changes, if you've been around for a while, you'll remember the FANGs. They were the tech companies, Facebook, Amazon, Apple, Netflix, Google, sometimes was added for Spotify. And they have now been sort of rebranded by the media into the Magnificent Seven. And while they continue to drive a lot of the S&P growth, where we see that real concentrated growth in particularly the tech, they've allowed us to sort of cherry pick the companies that have had the strongest growth. And it's been brilliant for anybody who has had the courage to hold on when everybody was saying that they're overpriced, they're due for a correction. Of course, we've seen sort of big growth coming in from NVIDIA, as we've seen the semiconductor, the AI theme. And that means the media has, of course, rebranded to FANG 2.0 for a really good reason, because we've seen this really strong shift in thematic. While tech remains really strong, we've seen fuels like oil and gas. We've seen aerospace and defense, one I'll talk about because we have strong exposure to that theme for a very good reason. Agriculture, as we look for more sustainable production and supply. Nuclear, as we look for cleaner energy solutions. And gold, of course, who would forget the rally of gold earlier in this year. And the really key thread among all of the best and worst performing thematic indices has been their very strong relevance or reliance even on political and geopolitical space. And specifically for that reason, if we look at the way we could use FANGs 1.0 or the Magnificent Seven, they were a single theme. They allowed us to cherry pick from that theme the specific companies that were strong. But then that thematic evolved into a more broader sector. We got FANG 2.0, and all of a sudden we have at least 5 different themes that were doing really strong or promised to do really strong in political and geopolitical uncertainty. The difficulty with that in a portfolio like mine, which is highly sort of concentrated, we only hold between 25 max positions at a time. It means that for concentration, we can't be exposed to all of these themes. You'll just be too thinly spread to really get the benefit from any of them. And so because they had this strong relevance or reliance on political and geopolitical arena, I decided to focus on getting the portfolio exposure to aerospace and defense for multiple reasons. One being that those spaces rely very heavily on tech, which is something that I understand more than, fuels, more than gold and metal, more than agriculture, although agriculture is becoming more and more intertwined with tech. But the aerospace and defense has always been a driver of tech. If you haven't read it, there's a great book called Sex, Bombs and Burgers. The title sort of gives it away, but it speaks specifically to the strong influence of aerospace and defense in tech for generations. Forever, tech has always been a driver for defense has been a driver for a lot of modern tech innovations that we see. And so for that reason, I decided to introduce this theme very strategically. As you saw, we have 30% exposure to it into the portfolio because I felt that it was going to be one of the strongest growth drivers. And that has really paid off in the first half of this year. Specifically, if we look at the Europe Defense Select Index, that closed out the first half of this year up 77%. And that's really because we've seen Europe, increase its defense spending, not only in its in-continent defense reliance in light of the war in Ukraine, but also as it aims to move away from its historical reliance in the US. So for me, this was a really strong theme to focus on, both in my diversification away from the US, because as I just explained, Europe gave strong indicators that they would diversify away from the US, but focusing on this theme specifically meant I could get exposure to Europe, but still get exposure to the US growth in this sector as a lot of those company RTX and Boeing still supplying a lot of the growth, even if those orders or contracts are coming through from Europe. So it was sort of a very easy win for me, although I am continuing to keep a close eye on the other themes as well, going into the rest of the year to see whether there might be more growth potential coming out of those. So if we look at the rest of the year, we have to talk about the dollar. I haven't talked about it in the review. I've left it for this because you can't really look at the rest of the year without looking at the dollar. The dollar has lost at least 10% of its value, and it is the most prominent capital rotation that we have seen for the best part of the last 2 decades. And we probably haven't even, seen the most of it. There is still to come from this. The dollar slump has meant that the euro is up 12.5%, Japan's yen is up nearly 8%, the Swiss franc is up 13%, and it's also given a really strong drive for emerging markets. Trump's re-engagement with Russia's Vladimir Putin has helped the ruble surge a whopping 40%. So it means that strong drive hasn't just been reserved for the West, but it's also gone right through to Ghana, which is a strong gold producer, which is up 42%. So the dollar's weakening has really given a strong board for all of the other currencies, and sets the scene really for the rest of this year. So what does that mean for this portfolio specifically? Okay, let's look at the themes as I have them in the portfolio. First up, AI, cloud, and cloud leaders. Here we're looking at drivers for hyperscale capex drives. We're looking at AI demand, the US dollar trend, because there is that, global orders, and we're looking at IT spend. We're specifically looking at NVIDIA supply commentary. I did a commentary yesterday about the US wanting to put location tracking into the chips because black market is really a big problem, and it is becoming a geopolitical race of who would control AI. In the cloud space, we continue to have strong exposure to Microsoft, Amazon, Google, looking at that strong cloud growth, and in Meta, looking at the AI infrastructure spend. Palantir, also a strong competitor here in our portfolio, where we're looking specifically at the government and commercial interaction. Key indicators here would be, for this part of the portfolio to outperform, is if markets remain risk on, if yields steady down, then we might consider trimming this discipline if there is a lot of vertical moves, which I have continued to do and will continue to do for the rest of this year. On the quality financials, continuing to look at capital returns, so buybacks and dividends. We've just come out of strong quarterly earnings, but I'm continuing to watch the yield curve shape and the credit quality. We have Goldman Sachs and JP Morgan, the US banks, in our portfolio, so keeping an eye on their fees, as well as the European bank payout guidance. So this is BNP Paribas and Allianz. So here, if rate cuts odds will rise with a soft landing, we'll keep an eye on those large cap finds. And if the curve flattens sharply, then do expect a churn of this in the portfolio throughout the rest of the year. For the defense and industrials, there is a backlog of growth, so there is still some runway here. Keeping an eye on government budgets, the aerospace and defense shipments, and that civil aerospace cycle. Watching out for the RTX order book, the GE aerospace margins. I have introduced Rheinmetall into the portfolio where there was some questions around, has that play not been over because of the, how much gains has come out of the Ukraine war. But there is still a lot of runway, I believe, in the contract wins. And then Rolls-Royce just keeps performing. The civil engine flying hours are a key indicator for us in keeping this in the portfolio. Then on the digital infrastructure, that data center demand, we keep talking about AI expansion, power constraints. So that's a strong one for us to look out for, specifically the Equinix bookings, interconnection growth, and sort of general commentary on power availability will be a strong indicator for us in this theme. However, I would say that this theme is a sort of tricky one. It behaves a lot like a REIT, so real estate investment trust, where it gets benefits from benign and cyclical yields. So I'm currently treating it more as a REIT-like element of the portfolio because it relies heavily on real-world infrastructure. So it gives us that benefit, but it can also give that lag or sluggish return that you don't necessarily get from the strong or volatile growth in the AI space or theme specifically. Cryptos continues to give us a hedge. I keep my core crypto portfolio to Bitcoin, Ethereum, and Solana in this portfolio as a combined core crypto, never really more than 5%. And I recently rotated out of Solana into Ethereum, which was great timing because Ethereum had that sluggish returns, which has given us a return of 50% in the last year. Here we keep an eye on liquidity, and the US dollar again plays in here, and we'll keep watching out for the throughput and the uptime, and just keep this as a satellite, keep this as a buffer that could give us sort of outsized swings on those macro surprises, which is what it has given in the portfolio, continues to give. And so that's why I continue to keep it in for the rest of the year. All right, with that, it wraps up the portfolio update for the first half of this year, outlook for the next half for the rest of the year. The portfolio has performed really strongly this year. And if you remember at the end of last year, I talked about how I would adjust the portfolio to have a bit more exposure, a bit more risk on than we have been in the last 2 years. And it's really, really paid off well. I really have been, pleasantly surprised in how well that has paid off. I'm going to continue doing that strong monitoring into the second half of this year. And I will continue updating you on the progress of that. And if you have any questions on the portfolio, please just drop them in the comments below. And I will continue with my regular updates on the eToro page, and make sure to drop any questions below and reach out to me either here or on LinkedIn if you want to get in touch directly. Until next time, keep well. Bye now.